you know the Dave Ramsey concept of using the envelopes and creating a debt snowball, right?
Yeah.
Well, think about if you were actually funding your life insurance policy that way, and you were putting more money into your life insurance policy each time, allowing you to build cash value inside the policy, and then using the provisions inside the policy, which is a policy loan, the value of the policy stays the same and continues to grow with that same interest rate and dividend, right?
Yeah.
But now you're accessing the money. It's not treated as income because it is a loan, and by definition, a loan has to be paid back. So now you're using that money tax-free to actually go out and pay down your other debts. And you're treating now, you're actually creating your own bank system.
Welcome back to the Life Insurance Academy podcast. I'm rolling with my homies. That's what the kids are saying. And today we're going to talk with you about the 5 top ways to make money in life insurance sales.
Boom.
Boom. That's what
an
we're talking
opener.
about. Boom. Let's go. Let's talk about
go.
it. Roger, you talk about it, life insurance sales, and you say it's the greatest industry in the world.
It's the best kept secret in the world.
Best kept secret. Yeah.
I think it's the best kept secret in America.
Why is it still a secret?
Is it a secret?
Because where is this being taught in school?
Yeah, it's not.
Where in the school system, elementary, middle school, high school, is it taught like being an insurance advisor or a financial advisor is one of the top professions that you can get into and it's a career path you need to pursue? Where is that?
One, it's not. Two,
Exactly.
Did you guys take business classes?
I'll tell you
in
what,
high
the first
school?
time I got introduced to it, and I was like, insurance? I think I was in 4th grade, and they had the Junior Achievement Program.
Yeah.
Oh, yeah.
And
I
some
remember
dude
that.
walked in a full suit. You're a traditional insurance guy, right?
Yeah.
Full suit, leather briefcase, clipped the little clips, popped it open, passed out all these things. And it was talking about like the economy, and it was a Junior Achievement poster type thing. But he was an insurance guy. And I didn't even know what an insurance guy was.
Yeah.
But that was the first time I got introduced to it. But from there on, I didn't know anything about it.
I remember going into career day for Ashlyn when she was in elementary school. And she asked, they wanted some people to come in for career day. So she asked me to come in. So I went in with like $100 in cash.
Oh, that's
Yeah.
That'll get some attention.
And I handed everybody, I think there was like 30 people in the class or 25 or something like that. And I just divided it up. It was 25. I gave them like $4 each. But then I had to go around and say, now, if you want to buy your insurance, it's going to cost you $1. Who wants to buy insurance? And we just went around and some people chose not to and some people chose to. And then I say, okay, now something's going to happen. That's bad. And so I went through this whole scenario and their house got hit or their car got hit or someone in their family got sick. And then they had to pay out the money. And then at the end, like the person who had the big policy got all the money and I took all the money from the other people and gave it to that one. That one person was like,
I'm a believer.
It was like 2 or 3 people got, some people lost their money. Some people ended up with just $1 left. And then one person, when they were paying
That
it,
was
I
really
took
good.
and I pulled it.
Yeah, except 20 people in the class now hate insurance.
I talked about how insurance
And it was
pays.
Ashlyn. Ashlyn got all the money.
No, she didn't actually. It was one of her friends.
Dad, why couldn't
But-
you just be the firefighter?
But I pooled the money, and then of course I gave him some other little widgets too. Ashton said they were talking about that
Oh,
for
I
like
bet.
2 weeks. No one's ever
Yeah.
brought in money before and explained insurance. But like it was never taught to me. No one ever told me about power of insurance, financial services, how like you can use insurance for different things. Like we're going to talk about the top 5 ways to make money in insurance
Right.
today. And I think even some of the things that we're going to talk about, most people are not even thinking of. They don't even realize you can use insurance for that.
Yeah.
Let's get into it.
Okay. So we're and I guess we could call these niches. Is that the best way to say this?
Yeah. Niches.
And people say there's something in the niches. What's in the niches, Zach?
Riches.
There you go. Right. So the first one that probably we talk about pretty frequently. Well, the first 2, but first we'll go with final expense. Final expense.
What is final expense?
Right.
What's final expense sales and why is it? What do people buy it for? What's the purpose of it?
Yeah, it's funny about final expense. I didn't know what final expense sales when I came first talk to you, Roger. I didn't know that was included in insurance because honestly, and just like most agents out there, most people out there, that's a segment. It's a portion of the population that is kind of forgotten, and you don't understand, because if you don't, or you didn't grow up in that demographic, it's hard to realize that is a need, right? But final expenses is it's a protection put in place for families that not if, but when something happens to their family, that there is guaranteed money set aside to cover any funeral or other arrangement costs.
What something happens to the policyholder.
If something, if something passes away. And the reason that is there is because this segment of this market is typically for lower income families that don't have the financial ability. A lot of them are Social Security, disability, and they don't have the financial ability due to whatever circumstances to be able to have a large amount of money saved for emergencies, for if a family member passes away, that they can't just go write a check for $10,000,
Correct.
$15,000, $20,000, and or would not be negatively financially impacted if somebody in their family passed away, as far as paying the bills and being able to live the way they normally live.
Yeah. So these are policies that are designed. They're called simplified issue policies. Simplified issue means they're not hard to qualify for. As with any life insurance policy, you have to qualify through underwriting. So they're going to look at your health. They're going to look at any health impairments, your age, and any medication, whether you smoke, not smoke, whether you've had any, issues with like cancer or diabetes, heart attack, stroke. Like, they're going to look at a group of these things, and they're going to do a simple process to get you approved. Now, most applications will have approvals for maybe 1 or 2 or 3 levels of acceptance on one simple application. And so final expense or insurance companies have realized there is a niche here, and they've created insurance policies that are simple to apply for and simple to qualify for, taking into consideration predetermined health conditions already accepted. And a lot of them you can get an instant approval right there, especially if you're using an e-app. You can sometimes you can get an instant approval right there while you're still in the home of the client, which makes it easy. And you just set up a monthly payment for the client to pay once a month, and it guarantees that lump sum. It's typically a whole life policy. Sometimes people use an IUL, an Index Universal Life, for that, but it's not a true final expense policy. So they're whole life policies that are designed with a guaranteed payout, so that family can get that check for $10,000, $15,000, or $20,000 to take care of those costs.
Yeah, I want to say this is huge on the list for a couple of reasons. For one, it's a huge emotional impact on the client, emotional and financial, to really take care of them. But when we talk about one of the 5 ways to make money in life insurance, it's one of the only segments of life insurance that advance you on issue a lot of time instead of on first draft date.
Yeah.
So for an agent, when you're talking about having cash flow, a lot of traditional life is sometimes it can take weeks to get approved if it's fully medically underwritten, even if it's simplified issue, like a term product in a different segment that we'll talk about. A lot of policies and plans don't pay out until the client makes their first premium, which could be 30 to 40 days from the moment you sit with them. In a simplified issue final expense arena or space, you literally can serve a family. You can get an approval through an online application or a phone interview, a lot of cases, to see if they're approved or not while you're in the home. You generally 10 minutes.
Yes.
Or on the phone. But as an agent, you can actually have a 9-month advance on your commissions within the next 24 to 48 hours from the time you sat with that family, which makes it very attractive and lucrative opportunity to serve families.
Yeah. And I would say this is profitable because there's a lot of seniors. Was it 10,500? Is that number still right?
Probably pretty
people
close.
Hitting retirement age
every day in
every
America.
Day. Yep. And it's usually not affected. Well, I guess we would say it's recession proof, right? I mean, we've been doing this long enough. We've seen different administrations. It hasn't been affected. People are typically on Social Security anyway. They need this coverage. People are passing away. The cost of funerals continue to go up. Inflation's going up.
Yeah.
So it's
but why is it recession proof?
It's recession proof. they're getting a consistent payment on a regular basis from the government
That's
in most
huge.
cases, right?
That's huge.
Yeah.
That's huge.
They're getting a consistent paycheck, and people continue to pass away. I mean,
Right.
we have a life expectancy. Right now, it's around 75, 76. You know, there's a few years variation in there for men and women. That number's starting to push up a little bit with medical improvements. But I mean, when you think about mortality rates, nobody gets out of here alive.
No.
Like it's a need that's always going to be there.
Right.
Even some people who are in the middle income classification, I would say, you know, I know you mentioned lower income, but even people that are in that middle income who have planned well and maybe have things allocated, and like for astute people, they will look at it and say, I would rather pay $42 a month than have to liquidate $15,000 from our bank account, because I can leave more to my family if I put aside $42 a month. I can handle that.
It's simple.
And that way, the $15,000 that I have in the account that was going to go to the funeral now stays with my wife, or stays with my husband, stays with my kids. And so, people who are educated that way, they find value in investing in one of these plans too.
It's simple, and it's an easy solution for their families as well. So
A lot of time we call that asset protection.
Yeah.
Yep.
Yeah. So it's one of the top ways. The other thing about it that's really good is that it's because it's recession proof, and because there's a large pool of people, it's easy to market to that large pool of people.
Yes.
So lead generation, there's a lot of good options for lead generation, whether you're doing direct mail or online ads through SEO search, through Google, you know, the different platforms, even Facebook. Like there's a lot of different ways that people are reaching that demographic to say, hey, there's plans available for you to take care of your final expenses.
Yeah.
You know, the government still only pays $255, you know, if you're living with your spouse.
Right.
At the time of passing.
I can't believe that's still a thing.
He's trying to sell you a policy.
He is.
Yeah. And so most people don't even notice $255 anymore. And that's not going to help with anything.
No.
I don't even know why it's a thing.
Right.
Yeah. So people need this coverage, and it's one of the top ways that people enter in this business. So it's a low barrier of entry. It's not a lot of high marketing costs to get started, and you can make money very quickly, as Zach said. So it's one of the top ways for sure to make money in life insurance sales.
The next one that we have listed is mortgage protection. Mortgage protection.
What is that?
Mortgage protection is typically a term policy that would protect a new mortgage or a refinanced home from the person who is paying for the mortgage to make sure the family's staying in the house, whether they pass away. And a lot of these new term products have living benefits attached to these. So if they had a chronic illness, a critical illness, if they survived a heart attack, a stroke, or even active cancer, they'd be able to liquidate a portion of the face amount to live off of, or pay some medical bills that could put them at risk of not being able to stay in the home, or continue to pay their mortgage or whatever. So this one is a little tricky because it's not as recession proof. It's based on the market. It's based on the data that's available from people who are purchasing homes. And you know, we're sitting here in 2023 in the front side of what people are saying a recession, right? And interest rates are slowly climbing up. I think they just did another increase. It was 25 points or something like that.
Went up another quarter.
Yeah, it went up another quarter. So what we've seen as a result of that currently is less refinancing going on. New home purchases are still happening, but it's not as easy to generate marketing. Am I correct on that?
Yeah, you're right. It's interesting because when we say mortgage protection, people think there's actually a life insurance policy called a mortgage protection plan. And it's really not. It's a marketing niche. So when we talk about the top 5 ways to make money in life insurance sales, it's just a niche to market to, because there's a recurring need that is clear. And so people market to that need. So when people buy a new home or they refinance a home, they become aware of the investment they've made in this large asset. And the people that are living in that home are generally the people they care about the most. And so if I'm going to protect that, how can I best do that? And so that's marketed to in that language, whether something should happen to them, you know, while they're alive physically, they're with an impairment, or should they tragically pass away, that their family has those resources. But interestingly, the type of policies that agents can utilize to cover that or give families peace of mind is broad. Primarily, we think of a term policy. Right. So a term policy in the most basic form is a stripped down life insurance policy that you see advertised on the radio. You can get $100,000 for $19 a month. Well, that's like a 22-year-old female, with a 10-year term with no bells and whistles. There's no living benefit. Like that may not be the exact quote, but it's going to be something like that. It may be more coverage than that, really, for that amount. But so that's the basic level of coverage, but they go up from there. So it's the term policies that have living benefits added on. There's term policies that are not fully underwritten, but move into the simplified issue category that have those living benefits typically. Then if they don't qualify for that, or they could use another option with like an IUL, an index universal life policy, to say, well, we can protect your mortgage and give you some cash growth and opportunity to access some money in the future, tax-free in the form of policy loans. We can cover both here. Well, if you don't qualify for that because of health reasons, you pivot to a whole life product.
Correct.
Or a simplified issue whole life product, or even a final expense type product, depending on the age of the person. Because we've had people in this past year, when interest rates were really low a couple of years ago, we were getting people 65 years old, 68 years old, refinancing their house. Or they're selling one house, downsizing, they got a new mortgage on the new house. They fill out a form saying, I want mortgage protection. But you're looking at someone who's 68, 70 years old. They're typically not qualifying for a 20-year or 30-year term at that point. You're going to move them into a whole life product. So the niche is mortgage protection. The type of product that you would utilize are broad. It gives you a lot of flexibility, and it's got a good marketing opportunity. So I think that's why that
I want to help be clear on this as well, because when a lot of agents that, let's say, aren't in this segment and they're maybe interested in, probably haven't looked into known, but there's really 3 types of insurance for your home. And a lot of it gets confusing. You have homeowners insurance, but who does that protect?
Protects the
home, right? The home, fire, tornado. It will help fix the home. It protects the home. Then you have private mortgage insurance, PMI, right? Who does that protect?
Protecting the bank.
That protects the bank from their investment, their money, because they've loaned out so much to you without a certain amount of down payment down or collateral down. So that protects them. So a lot of people think, I already got mortgage protection. I'm already protected. Well, mortgage protection, in the form we're talking about, is the only insurance that actually protects you and your family, meaning, as Roger said, if you or your spouse or whoever is holding that policy passes away, those funds, and it can be used in different forms of insurance, but the reason what that insurance is being used for is what mortgage protection is called.
Correct.
So in that event, it would provide money for the family in order to pay off the home, to relieve that mortgage, to make sure that your family can live there without having to worry about that payment and that roof being gone.
So or to make monthly payments on it for a period of years.
Yes. Or to
may
buy
not have
them
enough
time,
you may not have enough to pay off the entire mortgage, but you may have enough coverage to make payments for 3, 4, or 5 years.
And that's an important piece to it, because if you bought your house in 2022 at a certain value, you didn't put 20% down, right?
Yeah.
And now folks are finding that their values are decreasing, and someone passes away, and now you have to sell the house, and you don't have the equity to do it. Now you're dealing with a short sale or something like that. So having something in place that lets you stay in the home for another 5 years, 7 years, to be able to build enough equity to make some good decisions. Man.
Again, it prevents devastation.
Yeah.
That's
important stuff.
And this product and this niche can be sold over the phone through telesales, and there's great telesales platforms for that. It can be sold virtually over Zoom, and of course, good old face-to-face, meeting people in their homes at the kitchen table.
Last quick tip on it, because I know we spend a lot of time on mortgage protection. Talk about the money side of it. The leads are typically slightly higher cost than relative to a final expense or another type of insurance. Generally, they're very easy to convert, and the commissions are typically slightly higher because the monthly premium is higher, and that is all due to the demographic that you're serving here. Typically have jobs, typically have higher income, typically dual income, because they just purchased a home with a mortgage. So they're usually willing to spend more money protecting it. So the lead cost is a little higher. The commissions are higher. Like Roger said, the industry is changing to selling those over the phone at a rapid pace. That this has one of the highest potentials to turn large amounts of revenue daily by working it properly.
Yeah, it's a little higher investment on a regular basis, but that investment, if you work it properly, it gives you a higher return.
Yeah.
and you can do it virtually or over the phone.
And more product knowledge. I feel like when you're dealing with simplified issue, final expense products, you have something that's permanent. Here you're dealing with different time frames, different qualification processes. So you need to know your stuff.
It does take a little more training, a little more product
Mm-hmm.
knowledge, a little more astuteness
Mm-hmm.
in those conversations
Yeah.
to build credibility and confidence for sure.
Correct.
100%. Yeah.
All right. Now this one's kind of different for our listeners because we're generally talking about
Give it to them.
simplified issue in most cases in our podcast.
Yeah.
But this is a bank on yourself concept. So
Yeah.
I'm going to let you discuss that a little bit on
Yeah.
what that means.
Bank on yourself concept. What does that mean? So this covers a broad spectrum, really. If you think about how the bank uses money, they lend you money at a high interest rate,
Mm-hmm.
right? They
First they get your money.
get your money.
Yes.
Yeah.
They get your money first.
Yeah.
Put it in the bank. Make money off your money.
They lend
Then
it
they-
back to you at a high interest rate.
Yes.
Like it's a crazy system.
It
So
is.
essentially, if you can think of using like a whole life policy that has a fixed interest rate, oftentimes with a dividend, that pays out, that typically has a historical, track record. And yes, while they're not necessarily guarantees, you can look back through track records and see how they're going to perform. And you can have some certainty with interest on something like that. Like the concept of, the Dave Ramsey concept of using the envelopes and creating a debt snowball, right?
Yeah.
And once you get one paid off, you move that over and pay off the next one. Well, think about if you were actually funding your life insurance policy that way and you were putting more money into your life insurance policy each time, allowing you to build cash value inside the policy and then using the provisions inside the policy, which is a policy loan. Because a policy loan, if you take money out of a policy in the form of a loan, the value of the policy stays the same and continues to grow with that same interest rate and dividend, right?
Yeah.
But now you're accessing the money. It's not treated as income because it is a loan, and by definition, a loan has to be paid back. And you're
It's
now
not
using
taxed, right?
It's not taxed, right? So now you're using that money tax-free to actually go out and pay down your other debts. And you're treating now, you're actually creating your own bank system.
Okay. I got a question
Yeah.
about this.
Yeah.
So as you're funding this, it's overfunding. Is that correct?
You're max funding a policy. Minimum death benefit, maximum cash accumulation is the goal
Right.
when you're using these types of products. Yes, it has to have a death benefit because
Okay.
it has to still meet the
Mhm.
guidelines of what is a life insurance policy. It's not an investment. It's a life insurance policy, but it has provisions inside of it that allows you to grow cash value inside that.
Mhm.
And you can access that in the form of a distribution, which would be a payment that you have to pay tax on, or you can access it in the form of a policy loan.
Right.
Now, if the policy loan is at or below the interest rate than the actual policy has that it's
That's
growing
the
at,
question. Mhm.
think about how that works, right?
Yeah.
And so the cool thing is you can access those policy loans as the policy is growing. So you're trying to max fund the policy to use the cash inside of the policy tax free to pay down other things, and you can create that same debt snowball with your other lines. And we've seen people take their mortgages, typically use this debt action plan or debt free life or what do you call it?
Bank on yourself.
Bank on yourself
concept.
concept. And literally pay down and have a strategy to pay down their mortgage in 8 or 9 years.
So they're paying the same amount as they would.
They're just reallocating where the money's
How
going.
it's being paid, and
Yeah.
it's allowing them to grow money while they do it.
Correct.
That's mind blowing.
They're not even paying more.
right.
They're just reallocating and thinking differently.
Mhm.
There's been a lot of negative in the markets about using life insurance policies for this concept. Most of those articles are written by people who make money on the finance side, who make money on managed money.
Right.
Who the banks.
And there's a lot
right?
of fees and all that. They're making money off of that.
Oh my gosh,
Yeah.
all the fees and stuff like
Mhm.
in traditional loans and banks and even in traditional investments like your 401k and all that. If you put all that together and extrapolate it out and see where the numbers are, you'll realize, holy cow, there's a lot going out in fees. And the money managers, they're making a lot of money. And yes, while I do make gains, is there a better way?
Mhm.
And this bank on yourself or debt-free life, that concept has really taken hold. And for people who can understand the concepts and stick with the action plan, they can really eliminate debt at a fast rate and put themselves to become completely debt-free. using a life insurance policy. And typically they're whole life policies that are being sold.
Do you see the ones that pay dividends are participating? I guess we would call
Yeah.
them participating policies. Do we have much information on marketing for this? Is it typically a word of mouth?
Yeah,
Is
it's
it
a lot of warm market.
warm market?
Yeah, there's not a
Okay.
lot of, I don't know if there's a lot of lead generation.
Mhm.
I think a lot of the lead generation may come from the mortgage protection leads. Of course, once you're sitting in front of more people and you
Yeah.
start having conversations
Mhm.
about, hey, now you've got this mortgage. Have you ever considered another way of paying that down at a rapid rate?
Sure.
If I could show you a way where you could eliminate that 30-year mortgage and pay it off in under 10 years, would you be interested in taking a look? And for the people who are like, yeah, okay, now you have an audience.
Yeah.
Now you go back to them with a debt action plan.
Okay, that's very
Yeah.
good. That's good. So you can have that conversation with your mortgage protection leads that are being generated.
100%.
You can have that conversation in your warm market, and there are resources out there for lead generation, landing pages.
You're really
things like
selling
that.
two
Yeah.
policies now for the same
Mhm.
client. If you think about it, I just sold them a term policy with living benefits for their mortgage protection plan, and now I help them understand how they can pay that off at a
Yeah.
much rapid rate, at a much higher rate over here with this bank on yourself concept through a whole life policy.
Sick.
Yeah.
That's what the kids are saying.
Yeah,
They say
and
sick.
who's teaching this in college
Nobody.
or in school?
Nobody.
Nobody. That's why it's
The
still
only
one of
people
the
who
best
know
kept
are
secrets.
us
Well,
and these bobbleheads.
This is
That's
Life
it.
Insurance Academy.
The
and
bobbleheads.
it's pretty much equivalent
Right.
to Life Insurance College.
You're
right?
getting your degrees, buddies. All right. We gotta go quick here. The next one, tax-free retirement. What are you talking about, Zach? What are you talking about? Tax-free retirement? That sounds crazy.
It's a lot of it is a similar way, as Roger was talking about there. Typically, you're getting a minimum death benefit policy. You're overfunding it.
This is with an IUL or an indexed
Universal life policy.
indexed universal life policy.
Yeah.
Just say it. Say it to somebody with glasses on, not to like you wear glasses and say it, and you instantly sound smarter.
Let's see. I'm not sure if it'll work with
Indexed universal life policy.
You're away from the mic.
you.
Indexed universal life policy.
There you go.
Wow, dude, that was tough.
See?
That was tough. But essentially, you're typically overfunding a index universal life policy, which is meaning you're paying a lot more than your required premium.
For that specific face amount.
But that
Right.
specific face amount, you're trying to lower that face amount to the smallest amount that you're able to without the word MEC limits, without going over the MEC limits, which allows it to be still called a life insurance policy instead of a traditional investment of some sort. And you're allowing that money to accumulate month over month, year over year for a long period of time. And what that does, it's going to build up a massive amount of money inside of it for then at a certain amount of time or a certain time in your life that you deem, it could be age 60, 65, 70, or whatever you would want to decide to start pulling essentially a retirement. Instead of pulling a traditional retirement from a retirement account, what you would do is you would again borrow money from the money that you've built up, borrow money tax-free that you're able to live off of, knowing that you have to pay it back. But you're borrowing money, you're living off that money, but yet you have so much already accumulated in there that it's going to continue to grow. Just like
Because the interest rate is higher than
correct,
the amount you're
correct.
borrowing.
So instead
Is
of
that
your
right?
policy growing more each year, you're essentially going to start withdrawing that year's growth and living
You're
off
actually
of it.
not withdrawing it. You're taking a loan.
Taking
Yeah.
a loan.
Yeah.
There's a technical difference there.
Yes, taking a loan on it. But then let's say, if it's 40,000, 100,000, whatever you build out to, and let's say you take that, but then your policy grows again, a certain amount the following year, you will take another loan and you continue to do that every year. As your policy is growing, you're taking a loan off of the new growth of that to live off of. Now, whenever that day does come where you, let's say, pass away, it still acts as a life insurance policy, and the loan amounts that you've had paid into that will need to be they will come from the death benefit and the accumulation value that you have there, but you will still receive a death benefit beyond that. So essentially, you got that tax-free money every year withdrawal until you passed away, and then even when you passed away, you got what was remaining left in that policy because you were only taking the accumulative growth at that time.
The death benefit's going to pay off the loans first, and then your beneficiaries. When you say you get it, it would be your family.
Correct.
Yeah, your family would then retain any additional beyond after the loans are satisfied, and that still goes to your family. So the cool thing about the tax-free retirement concept, there's a book written a few years back which was really popular by Patrick Kelly called The Retirement Miracle, I think. And in that concept, he outlines like the 7 or 8 main features of this type of plan. But for me, the biggest no-brainer is comparing it to a traditional 401k or an IRA plan that people have through their work. Okay. And most companies will have an opportunity for you to invest pre-tax. The money comes out pre-tax. And oftentimes a company will even give you a match up to like 3% or 4% or whatever the limits are for the company. They'll match that amount of money. And so it's always people say, I want to put money into my 401k. The challenge with a 401k strategy, like if we look back over the last 20 years, for instance, or even 25 years to 2001, well, what happened in 2001, right? The towers got hit, right? The terrorist attack in New York City. And that sent the stock market plummeting. Well, everybody that was in a traditional 401k or an IRA program is for their retirement. Well, they took large hits in the following years. And those markets dropped significantly. And your retirement assets, so let's say you had $800,000, you were getting ready to retire, and the markets dropped 30%. You just lost $240,000 out of your retirement fund. Like, nobody likes that.
Right.
So all those people that were getting ready to retire, guess what they did? They kept on working. Because now they couldn't. Because then they were thinking, I just lost 240. I got to keep working until this bounces back.
Yeah.
And then, so that's the ups and downs of a traditional 401k.
Right, 2008,
those money, it happened again in 2008.
Yeah, they get back to normal, and then bam.
Yeah, and then it happened again this past year.
Yes.
The administration changed, inflation hits, oil prices are going up. There's a war in Ukraine, and all of a sudden, boom. Now the markets are plummeting again, and so now there's another 20% hit. And so we go through these big cycles of hits, and if you look at the actual return over a period of 20 years, it ends up being like 4, 5, 6% on a conservative 401k. Now, if you have a specific, money manager and he's managing you in stocks and you get in at the right time and you get out at the right time, and you can play the day trader game. Like there's people still trying to make it, but there's so many people that have lost everything in there. It's just not that dependable, right? And you got to have people who know what they're doing. And even then, it's still not a guarantee. The other thing about the traditional markets like that is that what they call, the average rate of return versus the actual rate of return on investments. So if you've got your money in a 401k plan and the markets went down 20%, right? Yeah. And you had $100,000 in, and it went down 20%. How much do you have?
80,000.
You have 80,000.
High five.
So you got that. You got that, right? So you got 80,000. But now the markets go back up 20%. What do you have?
96,000.
Where did the 4,000 go? You just lost $4,000. But it went down 20. Right? It went down 20. Yeah. It went up 20. But somehow the average rate of return is zero.
You lost $4,000.
But you lost $4,000 with an average rate of return of zero. Right? So the people on the investment strategy will say, now if it goes up again 20%, you know what I mean? Like these ups and downs, and they give you the average rate of return. It's a lie because we live on the actual rate of return.
Right. Yeah.
And so it went down 20, it went up 20, and everybody thinks we're back to square when we're not. We're still in the hole.
Roger, this is what everybody wants to know.
What's that?
How do they make money selling these IULs? How do you find the people for IULs? Who's the perfect person for an IUL?
Well, I want to tell you how the IUL works, and then you'll understand how to compare it to the 401k. So the IUL is completely different. The IUL, you put your money in, and it has a cap on what you can earn, and it's indexed against the market. Your money's not in the market, but it's indexed against the market, like the S&P. And the insurance companies then invest some of their money against what they have from you in the markets, and they will pay the fund, the index fund, an interest rate. But the cool thing about the index universal life policy is that interest rate, so if the markets are running at 12, 14, 16%, your cap might only be 10 or 11, for instance.
Right.
Or you might have a more conservative strategy where you're getting an average rate of return of 8 and the markets are running hot. But here's the cool thing. If we ever have a 2001 or a 2008 or a 2021 or 2020, right? Happen again. When that goes below zero and everybody else in the 401k and traditional stock market starts losing money, the IUL has a floor. You cannot lose. It stops at zero. You cannot lose any money. It has an annual reset provision in it. You cannot lose any money. So it protects your money. So it bounces at zero and stays there until the markets come up, and then it starts trending up again. And over the long-term performance of that, you really can accelerate the growth on your money. And here's the other cool thing. In retirement, when you start taking money out of a 401k, if you have $100,000, well, let's go to $1 million. I'm going to take it up to $1 million. If you have $1 million, you say, I want to take out $50,000 a year to live on in my retirement, and you do that in a traditional 401k, you got to pay your taxes on it yet. Because guess what? That was taken out pre-tax, and the government is counting on you paying that tax. And so you have to pay taxes on it. So now you're at $950, right? You're supposed to have $50. But what do you end up with? You typically end up with about $37.5.
Yeah.
Because you had to pay a percentage, 20%, 25%, something like that in tax. So you end up with $37.5. You paid the $12.5 in taxes, and now your investment's at $950 in an IUL. Let's compare it, direct comparison. You have $1 million. If you borrow $50,000, right, and the market is gaining at 6% or 7%, and you borrow $50,000 from your IUL is still valued at $1 million, and it's growing at $1 million. You got a loan against it for $50. It's kind of like having a home equity line of credit against your house. Just because you have a home equity line of credit against your home that's paid off, mortgage-free, it doesn't make your house worth less. It's still worth the same, and if the market increases, it's increasing on the max value of the home. You just have to pay off the home equity line of credit if you ever sell the house. Well, The same thing in an IUL. When you die, it gets paid off. So now you're taking $50,000 out, but the IUL is growing from $1 million up. The 401k is now growing from $950.
Mm-hmm.
And every time you take a distribution out of your
50.
401k, it keeps dropping. And if the market's ever tanked, that $950 goes to $750.
Right.
And every time it's got less earning power every time you take a distribution because you're paying taxes on it. In the IUL, it keeps increasing because of that zero floor and the full value of the IUL and the provisions inside that plan. So, man, you get people when they're young into these plans, and they can accelerate their life. So target market for these plans are literally babies all the way through to about 40, 45, even 50 years old. If they're properly funded, they can really take advantage of the provisions inside of a life insurance policy, and they can borrow from themselves. There's concepts for children called $1 Million Baby, where you're able to access money for college.
Yeah.
To help pay for college for kids in their college years, age 19, 20, 21, 20, whatever those years are. And the policy keeps growing. But if you start it when your child was 1 or just after they were born, the horsepower it has because of the longevity of the term of the policy and the low mortality rate, the low cost of insurance, and the high cash accumulation that's in that thing, you literally can turn that into a bank for your kids.
Yeah, that's great.
And use that money for future. It's a powerful, powerful vehicle. So tax-free retirement planning, the concept. There's some books like, The Retirement Miracle.
Yeah.
Patrick Kelly. Check it out.
I would, and from my understanding, there are lead sources for this, for tax-free retirement, general life leads. I know people who sell off that in regards to this. So there are lead opportunities. They are more expensive. I think there's a high cost to them, but these are generally much higher premiums, much higher.
Yeah, typically higher. It's a little more advanced sales. And in our space, they call it advanced markets.
Right.
Because you're moving towards becoming that advisor that's really helping them with their finances. Even though you don't have a license to manage money with variable, and can lose their money in the stock market, you can do all of this with a life insurance license.
All right, we got to move one more. And this is retirement protection in the form of a fixed indexed annuity. A lot of these conversations are happening right now due to what's going on in the market. We have agents who are actually discovering monies that clients feel like are at risk right now with final expense leads in the final expense conversation. These are seniors that they're sitting with. They're finding out that their 401k is doing exactly what you said in 2001 and 2008, and they're concerned, they're worried. But what makes a fixed indexed annuity safe? What makes it work?
Yeah. Well, for one, it doesn't you're not able to lose. Just like what Roger said, as far as the 401k, all the same risk factors are there. And let's say in a situation like this is typically somebody that's not a baby and maybe not super young, because of the difference between where you would use an IUL or a fixed index annuity is you're typically need to have those funds already established. People, if you don't have those established, the best route to go would be an IUL, start funding that young and building that up. If you have these funds established, let's say in a 401k or in another type of investment that has a very high risk, with all the uncertainty and everything's been going on, it's a lot of times it's a lot easier to take a portion, if not all of that, and move that to a fixed index annuity to where you only have the growth potential without the risk of losing, because you have that floor of 0. You can't lose your money on that. You can't take a 30% dip. You can't do that. And a lot of these different products nowadays also have a bonus attached to them to where when you do move your money over from another product or another investment to a fixed index annuity, a lot of times you can get, 2, 3, 4, 10, even higher percent.
187.5%.
Exactly. You can get a bonus, so they can start off with more money than they had before, and they can't lose any of it. And that brings a lot of security to a lot of folks, especially now. And these are becoming popular. And when you're talking about the mortgage protection market and all of these different, especially these last 3 that we've talked about here, one thing that's beautiful is it's hard to just come out of nowhere and be like, "Hey, Jim, how you doing?" You're meeting him at the grocery store, and I'll start talking to him about this. There needs to be like a gentle gateway or doorway that's open. And a lot of time that is a final expense conversation. It is a mortgage protection conversation that opens up the door for you to have these other conversations to help them in their finances in different ways, because you have that trust established already.
Or market too, family and friends. I mean, once you understand these concepts, they're easy to communicate.
Yeah, and you could tell you can hear the passion for them when somebody believes in it,
right?
Because they can see that. There's so many agents that we work with that literally go out there on a final expense lead and uncover $100, $200, $300, $500,000 annuity opportunities for families they were going to go write a final expense policy on, which is incredible because with the uncertainty and everything going down, interest rates going up, the mortgage market, everybody's kind of not buying or selling. They would like to sell, but the only reason they're not is because they have to turn around and buy. And so everything's they're kind of waiting and unsure. And the one thing they know is nobody has confidence in the market unless they possibly are a super smart day trader that can pull in and out all day long.
A lot of people are saying like it's not the same. Like traditional is scary to people. Like it feels not safe.
Correct.
Like it used to feel safe.
I think there's a shift.
Yeah.
There is a shift happening with finances for sure.
But the annuity is.
Yeah.
Annuity is
safe.
So you're saying it's basically a savings account that I can grow over here and I can't lose any money.
It can be a
and
death
I get
benefit.
a bonus.
You can use it as a death benefit or a guaranteed retirement for yourself.
And,
right?
a lot of financial advisors, traditional financial advisors who are in the stock market, brokers and things like that, they don't promote these because it's a one-time commission for the agent, so it's not an ongoing fee. They don't promote it as much because they're not, incentivized financially to promote the product, and it typically has a lower. It's funny because people say, "Well, there's more opportunity in mutual funds. There's more opportunity in 401k if you just let it ride." But what you have to remember is that when people are ready to retire, they're ready to retire. They don't have another 10 or 15 years for the money to come back to get the actual return back to where it was.
Right.
And if the market takes a dip, who's at loss? Well, the broker says, "Well, I'm sorry. Who could have seen this coming?"
Yeah.
Well, I look back at history.
Yeah.
Like put some of it into some guaranteed products. Put some of it into some fixed index annuities that's got some benefits. And a lot of them have multipliers for a death benefit. They get bonuses up front. And it gives a guaranteed interest rate, and so they're really, really strong products. And for an agent, these companies are paying out 4, 5, 6, some even higher percent.
187.
They're paying out that type of commissions on those. So,
just kidding.
And if you like a $500,000, if a $500,000 annuity is moving in, and you successfully get that funded to help that family, it could be paying you. I mean,
$25,000,
$30,000.
The thing I love about that is the agent can do something good for the family, give them peace of mind, eliminate their risk. That family also gets a bonus on their money, so it's like a commission for them, and then you get paid a really nice commission once the policy is issued right away as well. So it doesn't come from your client. It does. It's not like a fee to them, to where it's like, oh yeah, well I'm getting $25,000 of your thing. It's not like selling a house and the realtor, everybody's getting 3%. It's like, geez, but it's beneficial.
And clients are protected, and the insurance companies are protected in these things. Like clients have a free look, 30-day free look period after they put their money in these things typically. And the insurance companies are protected too, because you say, well, why wouldn't people just do that? If it doesn't work, pull it out and go somewhere else. They do have surrender fees. So in order to get the bonus and qualify for the bonus, like you have to leave your money in the annuity for a number of years, and the surrender fees get smaller and smaller as time goes on. Typically, their surrender fees end completely at 10 years, some less, but most of them, will have all the way a decline down to 10 years. So they do have some conditions, and people need to know what they're getting and know what they're buying. But a good agent can really help families in a tremendous way by utilizing this product. And here's the really cool thing, and we can wrap it up on this. This one doesn't require health underwriting.
Yeah, true.
This doesn't require health underwriting. In all other life insurance products, you have to qualify with your health, right? Your health, wellness, prescription drug check, your impairments, any things you might have. This is a suitability underwriting, which means we can't take all of their money and put in this product. Then they have no money for anything else in emergency, because that would be detrimental to them as well. So the companies will do a suitability test, and we'll say we can allocate this portion. And so it's just a financial underwriting, essentially. There's no health underwriting here. So if you've got clients that don't qualify for traditional health products or traditional life products, they can qualify for an annuity if they have the funds there, and you can use that creatively to help cover final expenses, end of life costs, all the other stuff that we talked about earlier. So
very cool.
Great products, man.
To recap, just in these niches, so much opportunity in this world. Final expense, mortgage protection, bank on yourself concept, retirement, tax-free retirement, and retirement protection. And to be able to sell these products, to be able to participate in this amazing industry, you need a master's of divinity. Is that right, Roger? Is that true?
I don't think so.
You just need a life insurance license.
That's it.
A
life insurance license.
And we'd recommend being a part of a group or an organization that can help guide you through some of this.
Yeah.
Be able to point you in the right direction, help you accomplish what you're trying to accomplish. There's a lot there.
Yeah. And if you need questions answered, if you need help with any of these concepts, if you'd like to be pointed in the direction of saying, hey, how can I get connected to a group that does one of these? Reach out to us. We're connected. These guys are connected. We can get you connected. We hope you enjoyed this episode of the Life Insurance Academy podcast. We'll see you next time.